Okay, in this chapter you're going to learn about some very basic derivatives contracts. They're the building blocks for everything else, and they're what we're going to spend the most time on this semester. The first type of derivatives contract we're going to be looking at is the forward or futures contract. The two concepts are actually very interchangeable. And then we're going to look at options. We're going to look at both calls and puts. A call option is an option to buy some underlying asset at a pre-specified price, whereas a put option is an option to sell the underlying asset at a pre-specified price. We're going to look at all of those in good time. With all of these derivatives contracts, there are fundamentally two different types of positions that you could take. You could take the long position, which basically makes you a buyer, or you could take the short position, which makes you a seller of the contract or the underlying commodity. And we're going to talk about each of those as we go along. What we want to do in this lesson is understand how these contracts pay off based on some underlying quantity, and therefore how the profit is determined on the contract. First of all, we're going to start by looking at forwards. By definition, a forward contract is a binding agreement between two parties to exchange some underlying asset in the future at a pre-specified time and at a price that you set today. Now, in essence, futures contracts are the same thing as forward contracts. The underlying idea is identical, but there are some institutional differences that we'll talk about later. But for right now, just think of futures and forwards as being exactly the same thing. Now, in any transaction, doesn't matter if it's a forward contract, there have to be some fundamental things that both parties agree on. They have to agree on what is the underlying asset, what is it exactly that's being traded, how much of it, so the quantity is important, how is delivery going to take place, where is delivery going to occur, when is it going to occur, and very importantly, what will the price of the transaction be? Now, in a normal transaction in the spot market, which is what we're used to thinking about most of the time, all of these things happen, this agreement is made, and then the deal is executed right there on the spot. The buyer pays the seller the price, and then the seller turns over possession of the goods to the buyer, and then the deal is done with no further obligation required by either party. With a forward contract, things are a little different. You see, with a forward, all of those things are agreed on in advance. The quantity of the asset, the type of asset, the price that has to be paid. But one critical detail is different. The transaction doesn't actually occur until a future date when the forward contract matures. And I'll give you an example of that later on. Okay, what you're looking at here are some example price quotes that you might see in the Wall Street Journal or another similar newspaper for some futures contracts. Now, as you saw in Chapter 1, there are actually many different underlying quantities for futures contracts, but what you're looking at here are price quotes for stock index futures. These are futures contracts that pay off based on the movement of some underlying stock index. You'll notice that there are quotes for Dow Jones Industrial Average futures, futures contracts on the S&P 500, on the NASDAQ 100, even the Russell 1000. Now, all of this information is given as of August 2007, and you'll notice that for most of these contracts, there's some information given for September and December. What does that mean? Well, it means that these contracts expire at different times in the future. See, you could have an S&P 500 index futures contract based on the same underlying index, but one contract may expire in September and the parties would have to settle up then, whereas another contract would settle up in December, 3 months later. Now, because of differences in the times of expiration, there are going to be differences in the pricing, and you're seeing some of that right here. Just really quickly, you'll notice that on pricing of these futures contracts, there's a value given for the open, which would be the first transaction price of the day, and then there's a high and the low. So how high was the price during the day, what is the maximum price during the day, and then a low, what was the minimum price during the day, and then finally there's a settle price. That's kind of like a closing price. That's based on the last transaction of the day. Then there's some information about the daily change, which means what is the difference in the settle price between today and yesterday. For example, on the first line of the table, where we're looking at Dow Jones Industrial Average futures for the September contract, the change is 18, and that's a positive number. It means that the settle price is 18 higher today than it was yesterday. The final column, open interest, represents the total number of contracts that are outstanding at that given point in time. Alright, now we want to look specifically at how these contracts pay off. That's going to depend on whether you're in the long position or the short position for the forward contract. Let's talk about those in a little bit more detail now. If you're in the long position on a forward contract, then when the contract expires, you are obligated to pay the forward price, and then you will receive the underlying good, the underlying asset, whatever it is. So the payoff to you in the long position is the value of that underlying asset on the expiration date, which is just its market price or its spot price at that time, minus the forward price that you agreed to pay at expiration. Now, on the other hand, if you are in the short position for the forward contract, then you've agreed to be the other side of the deal. So you'll be selling the asset instead of buying it. By selling the underlying asset, you'll be receiving that forward price as payment, and then you'll have to turn over possession of the underlying asset. So the payoff to you would just be the opposite of the payoff to the long position. So you'll be receiving the forward price and then surrendering the underlying asset. So your payoff effectively then is the forward price minus whatever the spot price is at expiration. Let's look at a hypothetical example. We're going to be looking at the S&R index. That's a hypothetical stock index. We're going to talk a little bit more in future chapters about real stock indices like the S&P 500, for example, and how futures contracts work on those. But for right now, let's just look at this hypothetical index. Let's suppose that today the spot price of the index is $1,000. So if you were just to buy the stocks in the index in proportion of what they were worth, then today it would cost you $1,000. Let's also suppose that the price for a 6-month forward contract is $1,020. Now that doesn't mean that you have to pay $1,020 today to buy the forward contract. Now if you want to enter into the long position on the forward contract today, you actually pay nothing. It's just that you agree to pay $1,020 6 months from today when the contract matures, and then of course you'll receive the goods at that time. Now let's just suppose that when 6 months pass, the spot price or the market price of that index is actually $1,050 at that time. The two parties didn't know it was going to be that amount going into the deal, but they agreed to exchange the index at $1,020, and so that's what has to be done at that point in time. If you're in the long position on this contract, then when it expires, you're going to be obligated to pay $1,020. That's the previously agreed upon price. That's the forward price at the time you entered the contract. And then you'll receive the underlying index, which at that point is worth $1,050. So effectively you profit $30 on the deal. On the other hand, if you're in the short position, then you're in the opposite situation. You've agreed to be the seller in this deal instead of the buyer. So you'll be receiving $1,020, but you'll have to surrender possession of the stocks in that index, which are now valued at $1,050. So effectively you lose $30 on this deal. Now in this slide you can see the payoffs to the long and the short position, not only if the S&R index ends up being $1,050 in 6 months, but at many possible different values that the S&R index could end up being at that time. After all, we don't know in advance where it's going to go at the time that we enter the contract. So for example, if the S&R index ended up being $900 at the end of 6 months, well, in that case, the long position would actually lose $120 on the forward contract. The reason why is because they'd have to pay the forward price of $1,020, and in return they would receive a stock index that was only worth 900. That's a $120 loss. Their loss, however, would be a gain to the short position because they would receive the 1,020 and then only have to deliver a stock index that was worth 900. Again, a gain of $120. Hopefully at least two things from this table stand out. Number one, you can see that any gain that one party makes on this forward contract comes from the other side of the contract. It comes from the counterparty. So if the long position makes $80, for example, in the case where the S&R index ends up being 1100, the short position correspondingly loses $80. And that's been true in every example that we've looked at. On the other hand, if the S&R index ended up being worth 950, then the long position would lose $70, but the short position would gain $70. So gains to one party occur at the expense of the other party. It is essentially a zero-sum game. Another thing that should be obvious from this table is that if you're in the long position, then you make more from the forward contract. You get a higher payoff and consequently a higher profit whenever the underlying index goes up in value. So the long position does better whenever the S&R index ends up at higher values at the end of 6 months. And they lose money whenever the S&R index ends up at low values. And exactly the opposite is true for the short forward position. You lose money whenever the price of the underlying index goes up, and you gain money whenever the price of the underlying index goes down. You can see this relationship a little bit better, perhaps, when we put it in graphical format. Here you can see the payoff diagrams for both the long forward position and the short forward position. You can see that both payoff diagrams cross the x-axis at $1,020. If the S&R index actually ended up being $1,020 on the expiration date, 6 months into the future, then neither side would effectively make any money on this contract, because they would be exchanging something worth $1,020 at that time for the pre-agreed upon price of $1,020. So it would be no harm, no foul, essentially. On the other hand, for every dollar that the S&R index finishes above that point, the long position makes another dollar in profits, whereas the short position loses a dollar in profits. Likewise, for every dollar that the S&R index price ends up below 1,020, the short position makes money and the long position loses money. Okay, so we've established that if you're long a forward contract, you make money when the price of that underlying index goes up. Well, how is that different from just buying the underlying index outright? After all, if you bought the stocks in the S&R index and that index went up in value, you would make money just the same. That's true, but there is a difference. To enter into the long forward contract, it doesn't cost anything initially. You don't have to pay anything to enter into the forward position, either long or short. You settle up at expiration. But to purchase the index outright, you actually have to pay whatever its market price is today, which in the case of this S&R index is $1,000, and then you have whatever it's worth at expiration. So is there any way that we could make the two positions more equivalent? That is, the forward contract versus the outright purchase of the stock index? The answer is yes, we can. We can combine the forward contract with a position in a risk-free bond. So what we're going to do is, in addition to the forward contract, we're going to invest $1,000 today into a risk-free bond that will pay off an effective rate of 2% over a 6-month time period. 2% of $1,000 is, of course, $20, and so the bond payoff at the end of the period is guaranteed to be $1,020. Okay, then let's look at the overall picture. If we take that combined forward contract with the risk-free bond and look at the two payoff functions put together, the long forward will pay off the spot price at expiration minus $1,020, which was the forward price, and then the bond will pay off $1,020. You add those two expressions together and you've just got the spot price at expiration. This relationship might be a little more clear if we look at the graph in figure 2.4. Here you can see the payoff diagram for the long forward position. You can also see the payoff diagram for the $1,000 investment in the bond, which is just going to be $1,020. It's a flat line regardless of what the S&R index ends up going to. And then if you add those two things together, you get the payoff function for the forward plus the bond, which looks suspiciously like the payoff function on the previous page for a position in the underlying stock index. And that's true. It is essentially the same thing. So what we've learned here is that the outright purchase of the underlying asset is a lot like having the forward contract in combination with an investment in a risk-free bond. Now, as an extension of this idea, we're going to see later on, in fact, that you could think of a forward contract as simply a leveraged position in the stock. That is, where one borrows money at the risk-free rate to invest in the stock. But we'll have more on that later. Okay, now that we've looked at how forward contracts pay off, both the long and the short position, I want to talk about a couple of other issues. First of all, the issue of settlement. And I want to examine cash settlement versus physical delivery. Now, so far, I've been talking about this hypothetical S&R index and the forward contracts on it as if we were going to settle up with physical delivery. In other words, if you were in the long position, then at expiration you'd have to pay the $1,020, which is the forward price, and then you'd actually receive possession of the stocks in that index. On the other hand, if you were in the short position, then whenever expiration came, you would receive the $1,020 payment, and then you'd be obligated to surrender possession of all the stocks in that index, in appropriate proportions, of course, to the other side of the contract, that is, the person in the long position. Now, actually doing that could entail significant transaction costs. And so what's more commonly done with these futures contracts, and it doesn't just apply to forward and futures contracts on stock indices, it applies to other things as well. But what's commonly done is what's called cash settlement. This is often a less costly and a more practical alternative, and you'll see what I mean. So if you're in the long position on a forward contract on this S&R index, and the index itself ends up being worth $1,050, and the forward price is $1,020, we already said that your payoff was $30. Well, with cash settlement, that's exactly what would happen. See, if we had done physical delivery on this contract, then the person in the long position would have had to pay $1,020, and then they would have received all of the stocks in the index, which had a total market value of $1,050. So in essence, that's kind of like the short position paying the long position $30. Well, with cash settlement, that's exactly what happens. The short position just pays the long position $30, and they're done with the deal. They don't have to go through the hassle of actually transferring ownership of all of the different stocks in that index. On the other hand, if the index had ended up being worth $900 on the expiration date, then the person in the long position would have lost money on the contract, and they would have been responsible for paying the difference between $900 and the forward price of $1,020, that's $120, to the person in the short position. As you can hopefully see, cash settlement is oftentimes a much easier way to go, and it avoids a lot of transaction costs. One final issue I want to talk about with regard to forward contracts is credit risk or counterparty risk. You see, the effectiveness of any strategy involving a forward contract, whether you're hedging, speculating, whatever your motive is, the effectiveness of any strategy is only as good as the person on the other side of that contract. You see, a forward contract or a futures contract is basically an agreement between two parties, and the contract is only good if both parties can be relied upon to keep their word and make a payment at expiration if the contract calls for them to do so. Now, this isn't really a big deal for, say, futures contracts that are traded on organized exchanges, because those exchanges have clearinghouses that guarantee the transactions. These clearinghouses act as the buyer to every seller and the seller to every buyer, and in order to make sure that all the deals go smoothly, they require all of the market participants to put up collateral whenever they make a transaction. That collateral goes into an account for them, and if their futures trades move in a favorable direction, then their account balance just grows. On the other hand, if the futures prices move in an unfavorable direction, then their account balance shrinks, and if it goes far enough, then the exchange can require them to put up additional collateral or close out their positions so that no damage is done and that they cannot default on their futures contract. Now, that's fine for futures contracts that are traded on exchanges, but what about things like forward contracts that are typically traded over the counter? That is, they're traded without a clearinghouse. There's just two willing parties that enter into the contract, and they hope that they can trust each other. In a case like this, it's probably not a bad idea to make sure that the two parties can in fact trust each other. So things like a credit check, certainly not a bad first step. It might also not be a bad idea for the two parties to put up collateral to ensure that if the deal goes against them, that there will be something there to cover their obligations. And sometimes the two parties might even consider having their bank issue a letter of credit on their behalf, making sure that if for some reason they default on their end of the deal, their bank will step in and make it good. All of these things can enhance the security and can reduce the credit risk involved with forward contracts. And that is important because, as we said, any strategy with a forward or futures contract is only as good as your counterparty is.